Active versus passive, choosing the right mutual fund strategy. When it comes to investing in mutual funds, there are two main strategies to consider: active and passive management. In this video, we will explore the differences between these strategies and help you make an informed decision on which one is right for you. What is active management? Active management is a strategy where fund managers actively pick and choose investments with the goal of outperforming the market. These managers rely on research, analysis, and their own judgment to make investment decisions. They aim to beat the market by identifying undervalued stocks or sectors, or by timing the market through buying and selling securities. What is passive management? Passive management, on the other hand, is a strategy that aims to replicate the performance of a specific market index, such as the S&P 500. Rather than trying to beat the market, passive managers seek to match its returns. They do this by holding a diversified portfolio of securities that mirror the composition of the index they are tracking. This approach is often achieved through index funds or exchange-traded funds, ETFs. Pros and cons of active management. Active management has its advantages. Skilled fund managers may generate higher returns, especially during market downturns. They have the flexibility to adapt their portfolios to changing market conditions and can potentially capitalize on investment opportunities. However, active management typically comes with higher fees due to the costs associated with research and management. Pros and cons of passive management. Passive management, on the other hand, offers its own set of benefits. By matching the performance of a specific index, passive managers avoid the risk of underperforming the market. Additionally, passive funds tend to have lower expense ratios, making them a cost-effective option for long-term investors. However, passive management does not provide the potential for outperforming the market, as it simply aims to replicate its returns. Choosing the right strategy for you. Deciding between active and passive management depends on various factors, including your investment goals, risk tolerance, and time horizon. If you believe in the skills and track record of a fund manager, and you are comfortable with higher fees, active management might be suitable for you. On the other hand, if you prefer a more passive approach, seek lower costs, and want to match the market's performance, then passive management could be the better choice. It's worth noting that many investors opt for a combination of both strategies. By blending active and passive funds, investors can achieve a balance between seeking additional returns and minimizing fees. This approach is known as a core satellite strategy. In conclusion, when deciding between active and passive management, it's important to consider your investment objectives, risk tolerance, and preferences for fees and potential returns. Remember, there is no one-size-fits-all approach, and the right strategy for you may depend on your unique circumstances. If you like what you are seeing, please do like, comment, and subscribe to our channel Personal Finance Unchained. Thank you for watching.